All right, welcome everyone. This is Bob Mauer. It is Friday, the 9th of August, around 3:45ish my time. Want to do a review of the current seasonal futures spread strategies, see how things are looking for our ongoing spreads, and then also I have one new one to introduce to you. We got a bit of cleanup here, some housekeeping as one of the spreads went off the board. Another one I tweaked a little bit as I walked it forward, and I think we just need to change a couple things modestly. So let's get into it. I'll show you what I'm talking about. Dialing into the portal, you'll see the most current PDF version right here. This will be for next week, going into Sunday. And here we have it. So this is the strategy sheet for what we got going on. And here are our spreads. So 312, bear spread in crude, flat, timed out. We'll see how that one ended up. Went off the board on 8-8. 313, bear spread feeder cattle, no fill yet. 314, bear spread cattle, filled and through the stop. But I know there are some out there who wanted to give this a little more room, so we'll take a look at how things are evolving. 315, bear spread natty gas, no fill yet. But as you can see by the grayed out areas here, things have changed. I revised a couple of the exits and entries. So we'll see how that has impacted that particular strategy and make sure that you get on your trading platforms and modify the orders if you want to follow along with me here. Otherwise, trader's prerogative. Feel free to do as you wish. 317 bull spread heating oil filled in that one. We'll take a look at it. And then 318 is the new one I'm introducing. It is a bear spread in wheat in the deferred contracts. So this is the May 25 or the March 25 versus the May 25. And it starts on 815. So I've got our entries based on the close that's going to happen on 815. All right. So day 0 is the first day of the seasonal window, which will be 815. And we've got the entries and exits based on that math. But I also want to give a qualifier on that one. Okay, let's hop into it, see how things are looking. So first of all, off the board is the crude. It timed out. This one worked out pretty good. All right, so had a rally before the first half of the seasonal window, allowing both the entry level 1, entry level 2, and entry level 2 levels to be filled, and then the market broke really nicely. Broke through target 1 of 45, so that should have allowed some people to either lock in all the profits and all their positions, or at least portion. Rallied for a couple days and then broke down, but didn't get down to the 28. I was kind of hoping it would. So on the final day, it actually had a decent bar to the upside, so it took away some of the unrealized gains, and it went off the board at 51. It says 51, but the range was anywhere from 40 up to 51, so you could have gotten out anywhere in there, obviously. And that's the way it settled up. So this one is going to go off the board as a winner. Should have ended up with some level of realized gain. All right. So that is or was strategy number 312, bear spread in the WTI light sweet crude. So that one went off the board. Okay, next one we're going to look at here is the feeder cattle. All right, so this is strategy number 313, the bear spread in feeders. Let me blow this up a little bit. Sorry about making your eyes work there. Strongly sideways. I mean, you see what I see, and what I see is what you see, and that's basically a strongly sideways market. Let's call the bottom end of the range negative 65, so really close to or just barely through our first target. And on the upside, say about, call it, right around a nickel. So about a 70-cent range. That's a $350 range. It's been stuck in for quite a long time, since July 8th. So a solid month, calendar month, right? It's been moving sideways. Now, I did walk this one forward, and the data still looks good to the short side. And it looks good to the short side at the entry levels that we've been looking to try to get in all along here. So I'm not going to tweak it yet because things still look good. So basically, no fill and no change to the strategy. We just need some catalyst for this market to push on up. And it's really kind of interesting because I think it's going to have to be the cash markets in the live and the feeders out there in cattle land, because normally you would expect some kind of rally in this market based on these low prices that we're seeing in the inputs, grains, for example. So we're not getting it quite yet. Market just seems to have found a value zone, wants to stick with it. So we just need some catalyst for this thing to pop up, hopefully let us on board, and then it rotates back to the downside. So that's where we're at, sitting on the sidelines. Feeder cattle, that's that. So now we got the fat cattle, bit of an opposite story. So again, as I mentioned, you should be stopped out. If you traded this according to the original plan, your stop would have been negative 87. You'd be out with some level of realized loss. And if these numbers come out to be about where you got in, then the risk would have been about 220 per spread if you got in at level 2, the more conservative entry level. If you averaged in and got them both, you would have lost about 640 per 2 lot that you averaged into. Now, based on me walking this forward, the data to the downside still looks good. And I know you're looking at a chart that's rallying, so it's really hard for me to say it still looks good, but it does based on the data, and the data is the driver. The timing of this is that normally, I should say, my assessment of the last 15, 20, 30 years worth of data is that you start to see a push to the downside beginning in about a week. So we might have to have another week's worth of volatility. Now, the original risk was 640 per 2 lot. Okay. And if you were only just a 1 lot trader and you happen to get in at level 2, and you wanted to keep the risk to 220, then you're out. But if you were somebody who was just watching how the thing traded and didn't necessarily get into both levels right away, there might still be some play. So if you want to keep that risk around 640, and let's say you only got in a 1 lot up here at negative 142, but you wanted to give it more room, well, the original risk was for a 2 lot trader would have been that averages in about 640. So basically, I guess the argument is if you originally had eyes on risking about 640, then you could give this a little bit more room. If you're just a 1 lot trader, for example, if you wanted to give it more room and see what happens. Now, basically, this thing formed a triangle. So you could see consolidation of lower highs and lower lows up until today. And today was the breakout. And just for illustration, I wanted to pull this little triangle identifier so you see what I'm talking about. A is the top, B bottom. That's the bottom there, the retracement. C is a lower high than A. D is a higher low than B. So you can see consolidation. You see the triangle forming that I'm talking about. And one of two things, actually I should say one of two things. A couple of things that could happen in here is that the market breaks out to the upside and fails, which would be great for us. Or it breaks out to the upside and hits its measuring objective. Classical technical analysis from my days with classical technical analysis would suggest that the measuring objective on this would be about 140 points from this level, which would be even money, somewhere right around here. Okay, and if it does get to that even money and you got in at the negative 142 level and you wanted to give it room, right? Because in my analysis, this thing still should be hitting some kind of toppy action if the seasonal tendency prevails in the next week or two, week and a half, then the risk could be 140 points, which comes to that times $4. So what is that? $560. So 560, which is less than the original 640 for the 2 lot trader. So I'm just kind of throwing out some math there, and obviously if anybody's still in it, wants to consult and strategize, feel free to reach out to me, but that's where we're at right now. So This is not going our way. It had an upside breakout from the triangle. Now we just need to see if it's got legs. If this thing fails come Monday, Tuesday, Wednesday of next week, that would look far better than where we're at right now. But minimally on the upside, if it keeps on going, classical technical analysis in terms of a bull flag like this, in my opinion, would come out to about even money, and then we'll see if she stalls up there. All right, so that's 314. No change to the strategy in as much as if you're out, you're out. If you're in, you're still in. And then if you want to further drill down on where the better place to put a stop would be, just to halt the risk, feel free to let me know, which I think is a great idea, by the way. The natty gas is the next one. This is strategy number 315. So this one I tweaked a bit. So I walked it forward, and based on my analysis, it still looks great to the downside, in my opinion. And had I not already published one, I published this spread, I would have been publishing it again because it still looks that good. I think even if I remember right, as of yesterday, if you were to get in yesterday, that it would have been a winner 14 out of the last 15 years. That's my recollection. But basically, I just want to do two modest tweaks. So over here on the right, you'll see I'm looking to change the stop level. It's going to go from negative 251 down to negative 254. So we get to tighten up the stop a little bit. Okay. So cancel, replace the stop, go from negative 251 to negative 254. Okay. And then for the entry level 2, I also brought that a little bit closer. I mean, I know it's only 6 points closer, but based on my assessment of the data, it gives us a higher probability of getting in, and allowing us to try to make some money on this particular one. So we're going to cancel the original second entry level of negative 268 and replace it with negative 274. Okay, so we're moving the stop, moving entry level 2. Everything else stays the same. And what did that do to our risk reward? So yellow is the previous strategy before the tweaks. Orange is the new strategy revised as of today. And what you can see is down here at the regular entry, our risk went up a little bit and our rewards went down a bit. And then for the more aggressive average in traders, risk stayed the same, but the potential gain went down $60 for target 1 and $60 for target 2. Okay. So modest. I wouldn't say that's an outrageous amount of change. And the nice thing was we were able to drop the stop down a little bit too, so that works out, in our favor rather than having the stop where it originally was, which means we would have added more risk for the lower gain. But we did the opposite here. Okay, so that is strategy number 315, nat gas beer spread. So basically no fills as of yet, and it has been revised in terms of the stop and entry level 2. Level 1 stays the same, and the targets stay the same. All right. So get on your platforms, call your trade desks, call your brokers, whatever you do. Get those tweaked if you want to follow along with us. All right, last one, or not last one, the 317 beer spread, diesel heating oil, long November, bull spread, not bear spread, bull spread. Long November, short January, and the market basically, we should be filled at entry level 1, somewhere around negative 75, and entry level 2 is negative 106. That is not filled yet. We are currently sitting, as we're heading into today's close, with a unrealized loss of about 10 points, which comes about $40 per spread. And we want this thing to basically be great if it just gets down to 107, push down a little bit more and then starts rotating to the upside along with the seasonal. So currently sitting with a modest unrealized loss. Only level 1 traders are filled. Level 2 are still sitting on the sideline. Everything is basically staying the same. No changes to the strategy. And then we've got a new one to introduce. So first of all, in yellow here, strategy number 318, this is the soft red winter wheat, also known as the Chicago wheat. Long May, short March. So we are short in the deferred contracts. Margin requirement 440. You see the risk reward here down for the level 2 traders and level 1 and 2 average in traders. Okay, so that's that. The caveat I want to give you, so this thing starts on August 15th, so we got a week. All right, a week from yesterday. So we're going to wait for the close a week from yesterday, next Thursday. And then we'll have our level, our day zero close. But in blue here, only enter if the market is steady or trending higher prior to the seasonal window start. Okay. If this thing craters going into Thursday, I don't want to do it. So bear that in mind. Only enter if the market is steady or trending higher prior to seasonal window start. So if it moves up a little bit, fabulous. Even if it moves steady, fabulous. You know, everything, all lights are green. So go for it. But if it is breaking, I want to look this one off. And the reason being, at these levels, there's room for it to move lower. Looking over long-term history, meaning that the differential between those two contracts could go to negative 20, and that wouldn't be unreasonable. But if it really starts breaking down, then our risk reward is going to get skewed trying to sell in the hole there. So right now we're in good spot, in the 12s, but I don't want to sell it much lower than that. So we'll revisit it come Wednesday and go from there. And what's the strategy? Well, we're going to wait for the close on August 15th. And then based on that close or at that close, if you're the more aggressive average in trader, you're going to go ahead and get short, knowing that the risk per two lot is 525 if you're able to average in. And then based on that closing price, the entry level 2 is going to be that price, day zero, the close of day zero, plus 2 3/4. Stop's going to be day zero plus 6.5. And then our target's going to be minus a penny half, minus 2 3/4, minus 4 3/4. All right, so based on that close, we're going to go ahead and set our entry levels and our exits. But based on that, the strategy, if you're a more aggressive average in traders, you'll be wanting to get short on the close on Thursday. All right, and I will publish the rationale behind. I'll post a video about the rationale behind this particular strategy, so you have some backstory. All right, so where do we sit? We are out of the board on the crude oil. That one timed out, ended up with some level of realized gain. We are sitting in unrealized loss territory in the heating oil and the live cattle. And then the other two, we are waiting to get on board. Okay, the feeder cattle, which the feeder cattle and the natty gas. All right, and then we had the one where we tweaked the prices just a little bit lower on a couple of the items there. Okay, came off a really wild start in the week, especially with the capital markets. S&P's tanked last Friday because of the unemployment number, and then fell again on Monday with some big follow through, and then all of a sudden things flipped. It's been pretty volatile, and those have worked its way into many of the commodity markets, not just the ones that we normally look to spread, but it's been a really interesting week and how it's kind of impacted currencies and interest rates and precious metals, and then obviously into our cattle markets and such. It's been a kind of a wild ride for a week, so we'll be looking for some stability, hopefully over next week. All right, I think that brings everybody up to speed. If you have any questions, comments, anything of interest, feel free to let me know. I'm going to leave it there, and thanks so much for watching.